Okie dokie. Okie dokie, everyone. First of all, I'd like to say welcome and thank you for joining me on tonight's webinar. Next, I would like to say either a good morning or good afternoon or a good evening or maybe a good night, depending, of course, on where you are around the world. Thank you for joining me on tonight's episode of the Discover Trading Series, the webinar series I'll be running for Wise Banc. Tonight's episode is called Discover Risk Management, written by yourself, of course. My name is James Alexander, and I'm the Chief Market Analyst here at Wise Banc. Let me do a quick introduction on yours truly. Like I said, I'm the Chief Market Analyst here at Wise Banc, and I've actually been in the financial service industry for really now for over 20 years. I actually started off as a mortgage broker where I specialized in commercial mortgages before moving into pensions and alternative investments. I got involved in the online trading arena around about 13 to 12 years ago. I've traded myself extensively through the Buy Gold and Commodity Exchange for a prop company where I actually traded gold options. I then ran a floor at the Philippine Stock Exchange before moving into portfolio management. And then obviously, I dabble now in education. I'm indeed a published writer and been published in several leading industry publications, including the likes of the Financial Times Advisor, quoted in Market Watch and The Street, and several industry magazines and newspapers. I'm an avid market commentator. I'm extremely passionate about this marketplace. Certainly, especially at the moment with the Brexit developments, all you cable traders out there, I guess you're very excited about what's going on at the moment. And then also at the same time, I'm a well-known public speaker, and I've spoken at several key events around the world, including like Singapore, Dubai, Qatar, Kuwait, Joburg, Pretoria, Cape Town in South Africa, London, obviously UK, Manchester, UK, Berlin, and just name just a few off the top of my head. And some people sometimes say that I do indeed like the sound of my own voice, and maybe sometimes I do. Now, tonight's episode, okay, as you've already seen, it's called Discover Risk Management. So tonight's agenda, we will cover why risk management is important in a very noisy world. Then we will discuss defining what risk management actually is, opposed to what some people think it is. Then we'll talk about what makes up a successful risk management program. Then we'll move into reward risk ratio, discuss the other educational events for November and December, and of course my usual at the end question and answer session. If anybody wants to ask me any questions in relation to the topic or about anything, if I know the answer, of course, I will tell you. So please hold your answers, also your questions, till the end. So why is risk management important? Let's face it, okay, let's be open. We have so much visual noise and information coming at us continuously when we're looking at trading. We have our charts to start with our different time frames. We have obviously our candlesticks, the movements, the wicks, the bars, etc. Then we have our technical indicators. We've got technical indicators we chuck into the chart, confusing us, showing us all these signs, visual stimulation, excitement. Then we have financial events happening all the time, the financial calendar filled with events coming out left, right, and center. Then we have news stories all over the press telling us what's going on and what's happening in the market. Let's face it, all this visual stimulation and noise can become extremely overwhelming. This is why we need a strict risk management program in our trading so we can keep our emotions in check and help us control our emotions with all this visual noise and information coming at us 24 hours a day, 7 days a week. Now, risk management is essential because of this. Now, even the most talented trader with, say, the most gifted eye or eyes for spotting opportunities will and can still blow their entire trading account in maybe 1 or 2 trades. Doesn't matter how good you are, you can still do that. You can still have 90% winning trades, but without a decent risk management program, your account, despite being 90% successful, can still be in a negative. Risk management, at the end of the day, is a very simple idea and can really easily be implemented in your trading. So what actually is risk management? Risk management takes into account that no matter how good you are, no matter whatever it is, or no matter how brilliant and everything like this, you will occur a loss. You will have a losing trade, if not many. The point of risk management is to try and protect your personal trading account from losing everything. It's not designed to stop you from losing, no, because you're going to lose at some point. It's designed to make sure your whole account doesn't get wiped out. Risk management is a method to control your overall exposure. Now, what makes up a successful risk management plan? Honestly, I can say risk. I haven't got a lisp. Risk. Try again, James. What makes up a successful risk management plan? First of all, a trading system. Second is controlling one's emotions. Third is money management. And those are the key things to have in your risk management plan. Now, a trading system. What do I mean by a trading system? I mean a strategy. Okay? I mean a process you go through every day, okay, to help you decide what you're going to trade, where your stop losses is, where your take profit is. It's like a checklist. It's a guideline which you follow so strictly, okay, so strictly that you never stray from it. Because an effective trading system really will help you stay to a set number of rules. Like I say, including entry levels and exit points, and technical indicators you may use, and the direction of trends or arranging market. You know, and this plan can include so many things, you know, like the indicators you use or the fundamentals you're going to base your decisions on. Okay. But the point of this, whatever this strategy is, and everybody has their own strategy or devise their own strategy. And in later episodes of the Discover webinar series, I will do one on how to build your own strategy. But the point I'm making here is without a trading system, without a strategy, without a set of rules you're going to be able to follow, you're going to fall prey to the emotions of trading, which automatically will lead you to losing. And this is all about controlling your emotions. This is the whole point of having a plan, having a checklist to try and keep your emotions in check. Because, you know, and this is a lot of things people do when they're on demo accounts. They make a big mistake trying to learn trading, trying to do a strategy on demo accounts or build a strategy on demo accounts. Because now, excuse me, let's be absolutely open and honest with each other. Okay? Demo accounts are totally different from trading live accounts. Okay, they have the same indicators. Yes, they look the same. Yes, the rates and the feed is the same, but it's totally different. And why is that? Because demo accounts, the money is not real, which means the emotions you're going through when you're trading on a demo account or trying to learn on a demo account is also not real. So you're not learning anything. Okay? Because when you're doing this, okay, and when you are trading and demo accounts stop you from doing this big experience, which every trader would go through, And this is the hardest battle every trader goes through and needs to conquer. And this is the battle between fear and hope. Now, I want all of you listening to me tonight have to think about what I'm going to say next. What I'm going to tell you about the battle between fear and hope. And I want you to admit or look at yourself and ask you the question, do I do this? And I know for a fact every single one of you does this, what I'm about to talk about, okay, or used to do it. And if you manage to crack it, then really, to be honest, you shouldn't be listening to me because you're already halfway there, okay? But ask yourself a question. Do I do this? And I know the answer will be, your answer will be yes. If you say no, then you're not being honest with yourself. Now, the battle between fear and hope is the most difficult thing, and it's the thing or experience every single trader goes through. Everybody has gone through this, and it's the hardest thing to crack. Now, let me tell you a story. This is fear first. Imagine this. Excuse me. You have a winning trade in the market. Okay, you have a profitable trade in the market. And what do we get? We get that happy feeling, don't we, in our belly that we're winning. Happy, excited feeling. But then what slips into our mind is that suddenly we start to worry that the market will turn against us and that happy feeling will disappear. So we'll start feeling happy. Okay, we're worried the market's going to take that little bit of happiness we are currently experiencing away. So what do? We close our trade and we snatch at that profit, making a very small gain. Let me tell you another part of the story. Imagine this. You now have a losing trade in the market. But this time, you don't close it straight away like you do with a winning trade. Oh no. Instead, you keep that position open, hoping that the market will turn around in your favor. But guess what? It doesn't. Instead, that loss gets bigger and bigger. And before you know it, you've got a very big losing trade in your account. Or either that is closes and takes out all your account balance. Now, like I said, this is the most difficult thing every trader goes through. And some people can never get over it. And like I say, be open and honest with yourself. I have no doubt in my mind's eye, you either do it now or you have done it in the past. Now, the battle of fear and hope is so difficult that if you look at majority of trading accounts, or like I say, or even your own, you could see a large majority of winning trades, but the account is still in a negative. Why is that? Well, you could also have 70% profitable trades. However, if you're unable to swap fear and hope around, the chances are your account will always be negative as the gains will be small and the losses large. So yes, you can have 70% successful trades, but the 30% could be bigger losses, meaning that your account is still in the negative. And really what you need to try and do, and it's the most difficult battle to do, is you need to swap hope and fear around. So when you're in a winning trade, you need to hope it's going to go up further. When it's in a losing trade, you need to fear that it's going to get bigger and bigger losses. So you need to swap it around, those emotions around when you're trading. And it is so difficult, because if you're able to swap it around, you could have 30% profitable trades, so 70% losing trades. But because you swapped fear and hope around, those 30% profitable trades have bigger profits than your losses, which could mean your account is indeed in the green and you have got a successful trading account. Money management. Now, this is the next key part of becoming obviously a risk management and controlling your trading, because the crucial element which will help with both your trading plan and controlling your emotions is managing your money better. Now, money management takes into the account the size of the wealth. Money management should be really the foundation between what size of position you take, the leverage you use, and the stop losses and take profit levels. It should all be dictated by that. The right money managed program also looks into long-term gains, not get quick rich dreams. At the same time, money management imposes strict risk guidelines. This includes the following: the size of your position. If you have, for example, $10,000 in your account, you should really be thinking of doing maybe a quarter of a lot, maybe now and then a half a lot. If you've only got $1,000, then you should be doing micro lots. Okay, you shouldn't be doing lots. It should be small, dependent on your contract size. Hedging. You should maybe consider taking small multiple positions at the same time in opposing markets, so that even though one position is losing, the other trade may not cancel out the loss completely, but it's giving you some money back, so it's not a complete loss. So hedging is a good technique to use. Setting stop losses and take profits. This is a discipline you must do, because straight away when you go into the market, you must set the parameters of the maximum you're willing to lose on that trade, and it should never be more than that. You should never be in a position where you've got no stop loss and you let the position get bigger and bigger and bigger. Straight away you should know the maximum you should lose before going into the market, and keep it at that. Same with take profit levels. And again, knowing when to take a loss, knowing when to accept the loss and walk away. Okay, it's that battle of fear and hope again, knowing that that trade is losing and basically enough is enough on that trade. Now, calculating the right amount of capital to risk, and this is again dependent on all a part of money management again, but it's depending on the size of your account. Okay, now the amount to risk per trade should really, like I say, be based on how much money you have in your account. If you have 10,000, then look at really like quarter to micro lots. To half a lot. If it's like 1,000, then look at micro lots. Okay, you shouldn't be going in doing lots, full lots with just 1,000, because you're going to wipe yourself out so much quicker by doing it that way. You've got to be looking at smaller amounts and based in what size of contracts you trade, based on how much money you do have in your account. Now the usual rule is 1% of your account balance on one trade. Now, this doesn't mean you only trade 1% of your account balance. No, I don't mean that. What I mean is that you can still use the amount you want to lose in a trade, but as long as your stop loss is set to the maximum 1% of your capital. So, for example, if you have account balance of, say, $30,000, you decide to open a trade with $29,000 as your margin to risk, but your stop loss should be set at the maximum loss of $300, not the full $29,000. You see what I mean? You're controlling your risk, and that is risk management. The risk-reward ratio. Every trader will have a losing trade no matter what, like I said. So this is why, depending how many losing trades we have or how many winning trades we have, the risk-reward ratio, the stop loss and take profit, is key here. The one right way of striking the right balance is trying to use this sort of risk-reward ratio like 2 to 1 or 3 to 1. For example, if you're setting a target of 20 pips, your stop loss should be at 10 pips. Or you're setting your take profit at 30, your stop loss should be around 10 pips. That sort of thing is what I'm talking about. By applying these risk-reward ratios to your winning trades, in theory, you should always at least double or have more than double than your losing trades. But this is not enough, as risk-reward ratio still needs to be disciplined. You still need to be really strict with yourself and really follow these rules to implement them, and be very strict with yourself when you're doing so. Trade, for example, here's an example for you. Trader A is aggressive. Okay, so he uses 60% of his capital, but he sets a target of 120%. Very aggressive target. Okay, Trader B is less aggressive. He uses 5% of the capital with a target of 10%. Again, doubling his risk. Which trader out of those two do you think has the more chances of being profitable? Answer is Trader B, because he's less aggressive. He set himself still a double target, double than what he's got at risk, but his target is practical. It's reachable. Whereas Trader A has got a larger amount of capital, 60% at risk, but he's gone for double of that, 120%. Okay, which is a risky trade because the chance of it getting there before wiping out the 60%, because it's a huge, huge goal, is unlikely or more unlikely. So Trader B would be more successful in this scenario. Right, future educational events coming up in the rest of November, should I say. On the 22nd of November, we have Discover Gold Trading. Then I'm going back to fundamentals because I love talking about fundamentals. 29th of November, we have Why Fundamentals Matter in Trading. That's on the 29th. And then, of course, we have the December schedule, which will be released very, very soon. If you wish to reach out to me, ask me any questions or make any more future suggestions on topics you want me to cover in the future, please feel free to either email me at james.t@wisebank.com, or you can indeed follow me on my Twitter account, which is brand new, which is at James Alexander T. And it's something I've just started last month. And on this Twitter account, by all means, you can follow me, but you can also direct message me. And you see that I post on a daily basis charts, levels I'm watching, and possible events happening in the market to keep you in the loop of what potentially is going down, or maybe something or opportunity or an area of interest. So that's me, James Alexander T. So please feel free to follow. With that out of the way, any questions related to the topic I've been discussing tonight? Any questions at all? Any questions at all? Hello, Google. How are you, sir? Hope you're well. Is there any questions at all? Anything anybody would like to ask me in relation to what I've spoken about today? Or you can ask me anything personally if you like. I might answer, I might not. It depends on what mood I'm in. Did everybody at least enjoy tonight's episode? Did they find it enjoyable? Did you like it? Anyone? Okay, does anybody have any requests or suggestions for future topics I might do in the future? You liked it. Good, I'm glad you liked it. Is there anything, good evening to you, by the way, is there anything maybe in the future you'd like me to cover, any topics or subjects you want me to do? Like building a strategy? Or is there maybe a case study? Maybe you're interested in me doing something like I'm doing next week on gold. Maybe you want me to do something on some other instruments, like maybe the euro dollar or the British pound or Japanese yen, or maybe indices or oil. Anybody like me to do anything like that? No? Okay. In that case, if there's no questions, like I say, if you suddenly have a question you suddenly want to ask me, you've forgotten about, or you don't want to ask me about today, please feel free, like I say, either contact me on my Twitter account, which is James Alexander T, or indeed you can email me james.t@wisebank.com. Or like I say, even if you've got some feedback, opinions, if you liked it, you didn't like it, be honest with me, tell me. And I will change or add more stuff if you want more stuff. Or if you're simply sick of my voice, I'll change my accent. Just joking. If there is no other questions or no other feedback anybody wants to tell me or put in, can I just say big thank you to everybody who have come along tonight. Thank you for joining me tonight, taking your time out of your busy schedule. Don't forget that this is recorded. The recording will be done afterwards, so please feel free to watch it anytime you like, to go over it. And like I say, please feel free to contact me if you have any questions. On that note, can I just say, no matter, well, or depending, of course, on where you are around the world, either a good morning, good afternoon, or good evening, or even good night, depending on where you are around the world. Till next time, can I wish every single one of you a fantastic day. Until then, until next week, every single one of you, trade safe.